Okay, good afternoon. So as Christoph says, my name is Neil Graham. And as he said, my background is that for 15 years or so I was a foreign exchange trader, money markets trader, derivatives trader. You know, I've sat at a desk with loads and loads of screens, and I've stood on an exchange floor and traded using hand signals and all the rest of it. I have been teaching for about 20 years, okay? So I work for a training company that I started about 20 years ago. People often ask, why did you leave trading and get into training? Well, the biggest trading position I have ever had is building this training company. It's now been sold and Fitch have bought it, so it's not really anything for me to worry about anymore. Over the past 20 years of teaching, I've taught CFA, I've written material for all sorts of exams, but it has been probably a long time since I've concerned myself with those official exams. What I basically do now, I train the graduates that the banks take on, so we'll spend maybe a month together doing training programs, sales and trading grads, investment management grads, investment banking grads, as well as going all over the world, training different organisations and comparing financial events and all the rest of it. Now, as Christoph said, the idea, I see my job to, my task in this setup, this masters that you've got to do, is to help you penetrate the thick hide of financial markets. Okay, financial markets are quite difficult to get your head around. If you've ever tried to read the FT every day and you've just given up because you haven't got the faintest idea what it's talking about, you're not alone. Okay, the FT isn't interested in teaching you about markets. What you need is you need a doorway in. You need to sort of get to grips with how things work. And that is really the job of the lectures, to get you interested in the topic. But the actual meaty stuff is in the reading that is assigned on the outline. Okay, so don't get caught out. We talk about some interesting stuff, some groovy stuff. And what I'm doing is I'm helping you to be able to sit down and do your studying, so you've got an idea, a framework around which to put the ideas. I mean, there are not any, technical ideas I will take you through, particularly in 504, but don't feel that the slide packs and the lectures are all that there is to it. Yeah? And also, it's important that you learn in different dimensions. After 20 years of teaching people and being paid for it, we have to get results, especially when it came to regulatory exams. And that you can read yourself, that's an important part of your learning. You look at somebody else demonstrating it, that's me. And you can actually get involved in the real world. You can read around it yourself. So it's important that you push and pull the knowledge backwards and forwards. Another thing, just to warn you, is that financial markets are technical. Okay, there's some maths involved and there's some economics involved. But don't go thinking that it is a discipline. Nobody looks after the language that we use, the jargon that we use. So it is constantly changing. And you're going to come across some products where the name makes no sense whatsoever. I mean, to give you an example, a credit default swap is not a swap. Okay? So why do they call it a swap? Well, there's another story behind that. And there's lots of reasons. There's a euro prefix that we'll talk about today. Okay, we talk about eurodollar, 3-month eurodollar. It's got nothing to do with Europe. It's got nothing to do with the European currency. It's a weird little prefix that we give in certain circumstances. So you have to spend time in this world learning and getting used to the terminology. You can't. It's not like physics or biology where it is all nicely sorted, kept, arranged, and you can rely on that term always meaning that term. unfortunately, you know, the markets haven't evolved that way, and it's just full of these sort of, you know, if you're learning a different language, you're sometimes told to watch out for false friends, which are words that sound the same in the new language as one you've got, but they have an entirely different meaning. Okay, and it's similar to that in financial markets. There are some words, they do not mean what they seem to say. So in 404, this is to get you warmed up and into financial markets. And we're going to look at why markets are important, types of financial instruments. Now, a financial instrument is something that we can invest in or we can trade. Okay? Trading and investment are two different things in financial markets, as you'll see. Classification of financial markets. Well, again, this goes back to what I was saying to you before. Be careful. You know, the classification that I can give you is robust and reliable, but it is very general. You know, it's continually evolving. People are always inventing new financial instruments and new ways of trading things. So to have a textbook on it is a thankless task. You have to write a textbook because it's always changing. Right, so classification of financial markets then. Today, we're going to begin by looking at the treasury markets. Now, the word treasury relates to somebody in a company, somebody in the finance department, whose job it is to make sure that the company has enough money running through its financial veins to keep it going. Okay? The treasurer isn't concerned with whether or not there's enough money to meet long-term projects. Okay, that's the CFO's job. The treasurer's job is to make sure that there is enough money to pay the wage bill at the end of the month. Or, if there's a surplus of funds, that surplus doesn't go to waste. It doesn't just sit there and not earn its keep in any way. That's what a treasurer in a company does. And so when we look at financial markets and we look at the treasury markets, it relates to this sort of commercial side of things. There are two elements to treasury markets: money markets and currency markets, or the FX markets as we sometimes call them. Now, money markets are about short-term lending. Okay, you'll see that this is principally cash. Okay, so a company borrows some cash for a short period of time, maybe 3 months. The currency markets are about, well, you can understand what it's about, exchanging one currency for another. But again, the way that the currency markets are structured is that it's really a market for the US dollar. Okay? Now, capital markets are how organisations fund themselves for the medium or the long term. Okay, so short term, money market stuff is up to 12 months. Whereas capital is more than 12 months. Okay, so 5, 10, 30, 50 years. Strictly speaking, up to 10 years is what we call the medium term. And there are two types of financial instrument here. There are equities, and probably tomorrow we'll have a look at what equities are and how they work. And then we've got fixed income, or bonds. Okay, so with equities you are inviting people to invest in your project, and they might lose all their money. With bonds, you are inviting them to lend money to you. Okay? Sorry, you're inviting, with bonds, you're being invited to lend money to the company. And the company is legally obliged to give you back the loan and pay interest. but we'll look at those, as I say, tomorrow. Now, all of these markets have another side to them, and that's derivatives. Derivatives are bets. See, if you think about horse racing, if you think a horse is going to do well in its career, you could go and buy the horse. And that involves a lot of capital outlay. I think the average yearling racehorse costs about £200,000, £300,000. But once you've bought the horse, all of it, and it does well, all of its prize money is yours, but the most lucrative part is afterwards, where it goes out to stud and you earn income from, you know, the horse in a breeding program. But you don't have to own the racehorse to benefit from its talents. You can make money by betting on the racehorse. And what you've also got to remember is that the owner of the racehorse knows about the bets that are being placed on it. Derivatives are like bets on equities or currencies or bonds. Okay? If you have an option, which is a type of derivative, you have an option on Amazon shares, it's nothing to do with Amazon. Amazon doesn't know anything about it. It's an agreement between you and somebody else with reference to Amazon shares. So we've got futures and forwards. Yeah? So you've got futures and forwards. That's one type of derivative. You've got options, and then you've got swaps. And these are bets, agreements. Okay, the analogy between horse racing, owning racehorses, and betting on them is quite a strong one with financial markets and derivatives on those financial markets. Tomorrow we'll have a quick look at some derivatives and you'll get the idea. So we're going to start with money markets. Short-term borrowing and lending. Now remember that for every borrower there's going to be a lender, and for every lender there's going to be a borrower. So now, in this world, in the world of money markets, corporations think about their liquidity situation. How much cash have we got? And supposing that we have a company and it realises that it's going to have a $10 million surplus for the next 7 days. Now, you might think, okay, well, we can just leave that on the current account at the bank. Okay, so Corporation A banks with Bank L. But supposing, well, it's a fact of life that interest rates relating to current accounts are very low if you have a positive balance, and they're very high if you have a negative balance. And what the bank is doing is it is charging you for the flexibility of a current account. Okay, you can, you know, your balance can fluctuate between 0 and many millions of pounds. You don't need to ask permission. Okay, and similarly, your balance, if you're lucky enough to have an overdraft facility, I'm sure some of you are no strangers to that, okay, but you can go from 0 to minus £10,000 perhaps. Okay, but once you get down, you know, once you're in that negative territory, the interest rate you are charged is very high. So a way round this, if you're a large company, what you can do is perhaps have a money market facility with your bank. And in a money market facility, the bank is saying, look, if you give us that 10 million for a fixed period, we will pay you a much better rate than you're going to get on your current account. And that's because the bank knows where it's going to be for the next 7 days. We've got your 10 million for 7 days, everything's predictable. So we're going to pay you a slightly better rate for it. And that's called the money market facility. Large companies often have money market facilities, and in our example here, Corporation A is going to deposit the 10 million for a week fixed at 1% per annum. Now, this per annum is the rate for a year. Okay, and it seems a bit odd that we're mentioning a week, and yet the rate appears with an annual suffix to it. We'll come to that in a second. And you can see, can't you, that the reverse might be true, in as much as we could have a corporation, Corporation B, who's got a 10 million shortfall for the week. Okay, they're not about to be insolvent. They can pay their debts. This is all about cash flow, liquidity. And Bank B is saying, look, we need to get money in to pay the wages at the end of the week. We're not going to use our overdraft because that's going to be really expensive. What we're going to do, we're going to use the money market. And we're going to borrow 10 million for a week at a fixed interest rate. In this example, 2% per annum. So this is an example of the real world of corporations doing real business using a money market facility that they might have with their bank. But we're not really interested. What we're going to do is we're going to focus a little bit more on the relationship between Bank K and Bank L. Okay, this is what we call the interbank market. So what's happened is that Bank K has found themselves with 10 million that they've got to pay 1% interest on to Corporation A. And if you're a bank, you've got to lend that money out to somebody else. That's the whole point of being a bank. You take money on, and you pay a low interest rate on it, and you lend it out, and you charge a higher interest rate for it. So it is possible, if you look at the numbers in this example, it is possible for Bank K to get rid of this surplus by lending it to Bank L, who needs it because they've lent 10 million to Bank B. You see? And so if they agree a rate of 1.5% per annum, they both make money, don't they? And you see that Bank K is receiving 1.5% on the deposit they make with L, yet they are only having to pay 1% to Corporation B. And we would call this the interbank rate. Okay, so when we talk about interbank money markets, when we talk about interbank rates, we mean the wholesale market for borrowing and lending money for short periods. Now, in actual fact, what might have happened if we look at this in slow motion is that Bank K may have called Bank L so let's say rate please. So Bank K gets on the telephone to Bank L and they ask them for a rate in $10 million for 1 week. Now what Bank L will do is they will reply with a two-way price. Alright, we're just getting into the bid-ask groove here. So now the two rates. Now if you go back to Bank K, can you see that Bank K has not declared whether they are lending the money or borrowing it? They've simply asked for a rate, please. Now in all wholesale financial markets, almost without exception, prices are quoted in two parts. On the left, 1.5% in this case, we have what we call the bid. Okay? This is where Bank L will take the 10 million and pay 1.5% interest. Okay, so potentially Bank K could do that, or Bank K could trade at 1.55, and they know that this is the price at which Bank L is happy to lend them the capital and charge them 1.55%. And this is called the offer or the ask. Now there's a lot going on here. First of all, you've got to see that the person asking for a price or a rate in this type of world doesn't say what they want to do. They're expecting a two-way price. Once they see the two-way price, they then decide what they want to do. And in fact, they might choose to do nothing. Okay, so the other thing you've got to focus on and make sure you're happy with is that there's a lot of common sense here. Isn't it obvious that 1.5% is the rate that Bank L would pay? And 1.55% is the rate that they would charge. Yeah? Because Bank K would get very excited if it was the other way around, wouldn't they? They'd say, sorry, you're going to lend to me at 1.50%, and I could deposit with you and get 1.55. Well, can you do more than 10 million for that? You know, Bank L would be very popular in the market. Everyone would want to trade with them, but they wouldn't last for very long, would they? So, you know, joking aside, the point is you can work this out for yourself. Okay, there's no mystery to it. If you are the entity making the price, your bid is what you'll pay, and your ask is what you want to receive. Whether that's in currencies, interest rates, bond prices, equity, option premiums, swap rates, everything has a two-way price element to it. So we would call this the interbank bid. And this is the interbank offer. Whereas, can you see that corporations, if we go back to our original scenario here, the difference between the bid and the ask that the corporates experience was much wider than the difference between the bid and the ask in the interbank market. You follow? Yeah? Because corporates, they're not part of the wholesale club. They're not part of the interbank money market community. And it's not unusual. You know, second-hand car traders will trade cars with one another at much lower prices than they would to somebody that's buying one as a retailer. Now, something really important now. In markets, we always like to quote things, especially things that have a percentage sign after them, on an annual basis. Okay, so volatility, coupons on bonds, yields, and interest rates are normally always quoted annually. Now, in 504, this is going to get quite fruity. Okay, it's going to get quite fruity. I mean, not tricky. It's just you just need to do it again and again and again and again, and it will click. Okay. It is not one of them things you just say, okay. Yeah. It's not a fact. Okay. It's an idea. Ideas are worthwhile. Facts, pretty dull and two-dimensional. So now, the convention is that when I quote a rate for a period in the money markets, I quote it on an annual basis. In other words, in the deposit that Bank L makes to Bank K, Bank L will not receive 1.5% of 10 million at the end of the week, because the 1.5% is an annual rate. They will receive 1 week's worth of 1.5% on 10 million at the end of the week. And that's what this fraction here is denoting. Now, you'll notice that what the fraction is doing is it's assuming that there are 360 days in the year. This is just a weird convention of dollars, euros, and yen. Okay, so for money market deposits, for dollars, euros, and yen, to calculate the interest payable or receivable, we take the actual number of days that the money was deposited or loaned for, and then we divide it by 360, because it's an easier number to divide by than 365. This market is over 200 years old, so you can imagine for most of its life, the calculations were being done without Excel or calculators. But in the UK, we've always been a stickler for doing things thoroughly and properly, and we're awkward, okay? So we use an actual 365 day count convention. Okay, and there's no logic to this, it's just the way it is. It's just the way the markets have evolved. Don't waste your energy on starting a crusade to sort everything out, because you won't win. Okay? And this is, you are going to come across lots and lots of conventions in markets. Okay? Conventions are just the way it's evolved, especially now that it's a global financial marketplace. And for 170 of the 200 years, they've been evolving in isolation, using local methods and traditions, okay, and conventions. And then there's always a compromise. So you're going to see lots of different countries using slightly different conventions. Now, if I was to ask you right now, what was Amazon trading at yesterday? Okay, you could go on your phones and you could go to Google Finance and you would look at yesterday's Amazon trading price. Now what you would be looking at is the price that Amazon finished trading at in New York on the exchange at the end of the day. Okay? During the preceding day, it may have been higher, it may have been lower, who knows? But we're all comfy with the idea that if I want to ask you a price of a particular company's share price on a certain day, we use the closing price to represent a typical value of that share on that day. Money markets are no different. Okay, so what we want is we want to be able to capture a typical example of where a particular money market period rate was on a particular day. Now, money market periods are basically overnight, 1 week, 1 month, 2 month, 3 month, 6 month, 12 months. Overnight is 1 day. You can borrow money today and you have to repay it tomorrow. Or vice versa. You can deposit money today, but you will get it back tomorrow with 1 day's interest. 1/360th, if it's dollars, euros or yen, or 1/365th if it's sterling. A week is pretty obvious. Okay, that's Monday today until Monday next week. Months operate on a sort of calendar system. So we would go, let's say, from the 7th of October until the 7th of November. Or we'd go from the 17th of June to the 17th of September as a 3-month. Now, what that means is that the number of days in a 1 month, a 3 month, a 6 month, or a 12-month period is going to change, isn't it? So that's why we have the actual number of days on the top of these fractions here. So it might be a 93-day quarter, or it might be a 90-day quarter. And you also get the really freaky situation where you have leap years, and you have 366 days on the top for a 12-month US dollar money market deposit, and 360 on the bottom. See what I mean by it getting a bit fruity later on? Yeah. So anyway, we want to capture a typical level of a typical rate for a certain period on a certain day. Now this is the 1 week rate changing throughout the business day. It's like a share price. Its value will go up and down. Now the central bank will have some influence over what this rate is going to be, but minute by minute it will move around what the policy or central bank rate is doing. And what the money markets do is they take their capture of the rate mid-morning at 11 a.m. This is because at 11 a.m. the market is the busiest. Okay, and for that we use the word liquidity. It is the most liquid about that time of day. And that means that the price is a good example. Whereas towards the end of the day, around about 3:30, the market's beginning to slow down, dry up, people are in the pub, people are paying attention to what they're doing. All the business is done mid-morning, and that's when the money markets capture the rate. Now the way that the rate is captured is by a weird ritual. Now, a bit of background on this. First of all of these currencies here, their money markets are principally in London. Okay, so short-term borrowing and lending of Swiss francs is busiest in London. The reason for that is because of old rules and regulations that other countries used to have that we didn't have. So way back, Second World War sort of time, every other country was a bit nervous about capital controls and all the rest of it, whereas we had an empire, we didn't care. Okay, so everybody found it easier to borrow and lend currencies in London rather than in their domestic, and it's just stuck. Okay. Now, when we take sample money markets for each one of these rates, we have a panel of banks that contribute. We don't have an exchange. Money markets don't trade on an exchange. They're what we call OTC, over the counter, and we'll look at that next week. Okay, so there's no exchange. So what we need is we need a panel of banks to help us do the rate capturing process. And on the next page, you've got the panel of banks in London that are used to determine the US dollar money market rates. You know, these reference prices for US dollar money market rates. Now, these are all banks that are based in London, and all of them participate heavily in US dollar money market type borrowing and lending. And this is the question that they are asked by the Intercontinental Exchange. Okay? The Intercontinental Exchange that captures the rate I know I said it's not traded on an exchange, but we've got an exchange that does the calculation process, that's all. So each one of these banks is asked, at what rate could you borrow funds? Were you to do so by asking for and then accepting interbank offers in a reasonable market size just prior to 11 AM London time? In other words, what the question is doing is asking the banks to imagine that they are in Bank K's position here. And they're saying, supposing you wanted to borrow some money and you went to the market, you went and asked another interbank operator, what do you think the offer rate is that they would give you? And can you see how sort of woolly it is? You know, what do you think? You know, it's not where would you trade at or give us a price now. It's what do you think if you went to the market? What do you think people would say to you? What do you think? And really, they could answer anything they wanted. And a lot of it's got to do with how creditworthy the banks are. So this is an example from a couple of years ago of the different rates that each member of the panel submitted on a particular day for 1 week US dollar. Okay, so we're talking about one currency and one period. The next step is to get rid of the outliers. Okay, so we get rid of the lowest 4 rates, we get rid of the highest 4 rates, and as there are 18 banks in the panel, we take an average of the remaining 10, and this is the reference rate for 1 week US dollars in the London money markets. Okay, this is the London interbank offered rate for 1 week dollars. All we're doing is capturing, sampling a typical value of the rate for that day, for that currency, for that period. So if we expand things a little bit, this is what a week's worth of LIBOR rates looks like for the US dollar in March last year. Okay, if you want to look at this in real life, go to globalrates.com. So can you see the first column here, 8th of March 2017, you know, what we were looking at is what would have gone into the calculation of that rate. But the same panel would have been asked to submit rates for what they think they could borrow at for overnight, 1 month, 2 months, 3 months, and then we get rid of the top 4, get rid of the bottom 4, take an average of the middle 10. There you go. That's the reference rate. Okay, it's important that you have a good notion of what a LIBOR interest rate is. Okay, because it relies, you know, you'll see it in corporate bonds, you'll see it in interest rate swaps, you'll see it when we do interest rate spreads. Okay, you need to know what we mean by that rate. It is an interbank rate. And that means it represents the credit worthiness of banks, not governments. It's not a credit risk-free rate, in other words. Now, given that London is the global centre for money market activity, we could have this sort of situation arise, where we've got Bank A agreeing to lend $50 million for a week at, let's say, 0.5650% per annum to another London bank, Bank B. Now, in order for Bank B to get their dollars, they need to have a dollar bank account in the US. Now, for some of you that are new to this sort of thing, you've got to get your head round currencies and banks. Okay, every economy has a banking system, and at the centre of the banking system is the central bank, yeah. And for the US, that's the Federal Reserve. It's the ECB for the euro. It's the Bank of England for us. It's the Reserve Bank of India for the rupee, and on it goes, People's Bank of China, and all the rest of it, okay? Now, the way that banking systems operate is that every member of that banking system has to have a reserve account with the central bank. Now, the central bank has to choose a unit of account to record how much money people have. And this unit of account is called the currency. The Federal Reserve happens to choose something called dollars. Now, at one point, it was easy to define what a dollar was because you would use a metal to back the currency. And you'd say, right, $1, or rather, you'd say 1 ounce of gold is worth $35 US. You know, Bretton Woods, 1947, that sort of thing. But now, what we do is we just use, you know, dollars are fiat currencies. They're not related to gold anymore. But the point is that it is the unit of account. Dollars cannot exist outside that system. Now, you know, I've seen Goodfellas, yeah. I know that you can take dollars in suitcases anywhere you want to, but those aren't dollars, they're promissory notes. They are dollars in limbo, aren't they? Cash is not real dollars. It's a promise to credit an account within the banking system for that amount of currency. So if we go back to this example, Bank B can only have dollars lent to them, paid into a bank within the US system. And that means Bank A themselves has got to have an account with a bank inside the US banking system to be able to make the payment from. And we call these dollar paying agents. These are simply American banks within the Federal Reserve banking system from which Bank A can pay the dollars to Bank B. And in actual fact, all payments on any day are netted down. Your payments, if you're a bank in the banking system, your payments and receipts are all netted down, and the net amount is paid through the central bank. So the dollars would pass through the US banking system to B's paying agent. Now the thing that we have here is we have a legal contract agreed in the UK, yet the dollars themselves are moving around in the US. This means that the contract is subject to UK rules and regulations and not US rules and regulations. Okay? Whenever we have this sort of situation, whenever we make a loan of a currency, whenever we agree a loan of a currency outside that currency's country, we call it a euro deposit or euro loan. So this is what we would call a 1-week euro-dollar deposit. Now the euro prefix has been used in this context for longer than the euro's been around, and in actual fact for longer than the European Union has been around. Okay, this started to happen late 40s, early 50s. Okay, and the reason why we use it is because this whole setup was first taken advantage of by Europe Bank du Nord. Okay, a Russian-owned bank or a Soviet Union-owned bank that used to pay its petrodollars into there. They couldn't freeze their assets because it was a it's all on Wikipedia for you. But the point is that this is an example where if I said to you 3-month euro-dollar interest rate and someone said to you, why do they call it euro-dollars, you know the faintest idea. Yeah. Whereas it's different, isn't it, to the 3-month euro-dollar foreign exchange rate, which is a forward FX rate. Do you see what I mean about the language? And that's why you need to get familiar with the context in which these things are used. So if we go back to here, what you've got here, can you see at the top? Example, euro-dollar LIBOR. Of course it's euro-dollar because it's fixed in London, isn't it? Yeah. It is based on trades, it's based on deposits that are agreed in London, so it's euro-dollar. Now, Fed funds. Okay, it has a D on the end. I worked with somebody for years that thought it was the Fed fund market. Okay, Fed funds. This is a money market in US dollars that happens in New York. Okay, so we've got the regular Eurodollar money markets happening in London, but we also have this very special case happening in New York. Now, firstly, if you are a US bank and you are lending loads to your customers on any given business day, there is a danger that your reserve account at the Fed might dip below the minimum reserve requirement, okay, the minimum acceptable level. And you've got to do something about this, otherwise the Fed is going to tell you off. Now, what you do is you work on the principle that because there's a fixed money supply, more or less, it's all going to be a zero-sum game. Because you looks like you're going to go below your minimum reserve requirement, there must be other Federal Reserve banks out there that are going to have a surplus. And everybody knows that you don't earn a very good rate of interest on your surplus at your reserve account with the central bank. So those banks are going to be keen to lend those Fed funds, those surplus Fed funds that they've got, to anybody that's willing to pay a decent rate of interest for it. So there is a market between Federal Reserve banks, Citibank, Bank of America, Wells Fargo. Okay, there is a market between them, and it involves lending surplus Fed funds to those that have a deficit for one day only. Money markets range from overnight all the way out to 12 months. The Fed funds market is overnight only, and it's quite an exclusive club. You've got to be a US Federal Reserve member bank to participate. Whereas anybody can borrow and lend dollars on the Eurodollar market in London. Okay, so Fed funds is borrowing and lending money between Federal Reserve banks for one day only. Now, because all of this happens via the Fed keeps an eye on it. And the Fed calculates at the end of every day a volume-weighted average of all the Fed funds trades that have been executed. And this is called the Fed funds effective rate. Okay, so this is the daily effective Fed funds, or Fed funds effective. Volume-weighted average of rates on trades arranged by major banks. Now, 10 times a year, the Federal Reserve has a meeting of the FOMC, the Federal Open Markets Committee. The FOMC is a committee, a group of people within the Fed that meet and make monetary policy decisions. Okay, now in plain English that means decide whether interest rates need to go down, stay the same, or go up. And they vote on it. Okay, and as an XFX trader, money markets trader, you know, you would be desperate to find out who voted what way during the FOMC meetings, because you're trying to get a sense if the inclination to move rates is becoming stronger or weaker, and the voting patterns really matter to you. But when the FOMC makes its policy decision, it will be associated with what we call a Fed funds target rate. Okay, so the Federal Reserve monetary policy official rate is called Fed funds target. Now, in my screenshot here, the Fed funds target was a range between 0 0.25%. And what the Fed is saying is that they are going to use their influence to make sure that the Fed funds effective rate stays within this target range here. Okay, so that's what the Fed funds target rate means. It is the official policy rate. It relates to the Fed funds effective rate, which is a weighted average of all Fed funds transactions that happen during the day. Now the Fed is the controller of the currency, so it can make sure that that's where the rate is going to stay. So you've got three Fed fund rates to worry about. There's the Fed fund rate, there's the Fed funds effective rate, and then there's the Fed fund target rate. And it's one of them things that when you're reading a textbook, you don't notice. You think, oh, they did call it Fed funds target a moment ago, now they're calling it Fed funds effective. You know, whatever. Treat yourself to another skill. Okay, now, money markets are really split into two halves. There's the short-term borrowing and lending of cash that we've just been looking at. The other side of it involves securities. Now, a security is a transferable piece of paper. Or call it a transferable loan for now. And in fact, put the loan in square brackets, because the security isn't always a transferable loan. But security is something that's transferable. Okay, so now, money market cash deposits or loans cannot be broken. Okay, so what that means is that if, like Corporation A, you deposit 10 million for a week at 1%, you can't go back 3 days later and say, oh, I've changed my mind, can I have my money back, please? I mean, legally, they have to give you your money back, but you will get no interest whatsoever. They'll charge you a penalty, a break penalty, and you won't get any interest. Now, for some people, for some investors, this is a bit inconvenient. What they would rather is the chance to liquidate their funds from a money market deposit before the maturity date. And what you'll see is that securities allow you to do this. So, let's look at a treasury bill. Now, as the name implies, this is the government. The government is borrowing money for periods of up to 12 months. Okay, so a treasury bill happens when a government wants to borrow money for periods up to 12 months. Now, governments, well, major governments, broadly speaking G20, are the safest place to put the currency. Okay, so US government bills are the safest place to put US dollars. Okay, sterling, safest place for that is UK Treasury bills. G20, roughly the G20. Who are they? I don't know, Wikipedia. There's some names in there that probably don't deserve to be in there. But you know what I mean, right? Okay, I'm not including Poland, I know, isn't familiar. Defence for like Poland. See, a government like Poland, or at least it did 5 or 10 years ago, would go and borrow money from a bank. Okay, whereas a major government will borrow money directly from investors. It will say, look, we're not going to pay a bank, we're not going to pay a bank a large interest rate to borrow money that people have deposited with the bank. We're going to go directly to those depositors. They're the safest place you can put dollars. So we're just going to go directly to them. And so every Friday in the US, there is an auction of US Treasury bills. And this means this is an open invitation by the US government for investors to lend it money. Now, what you have to do is you have to bid for the Treasury bill. And the government gets so many bids that it basically arranges them in price order and then gives the Treasury bills to whoever's bid the most. So in our example here, a lender has bid 99,750 for a Treasury bill with a face value of 100,000. Now, in actual fact, the bid that they would submit, they would say, I want to pay 99.75 per 100 nominal for 100,000. They'd always express the price on a percentage basis. And the US government accepted this on Friday, and they received their bill on Monday. Okay, the Treasury bill starts its life on Monday. Now, this is a 13-week Treasury bill, which is basically 3 months. So it will redeem in 13 Mondays' time. And when you redeem a Treasury bill, you simply give it back to the US Treasury, and they pay you the face value. And that's all there is to it. There is no extra payment. Okay, the US government doesn't pay you any interest. It just pays you face value at the end of the bond's life. I beg your pardon, at the end of the bill's life. So can you see that for you to receive any sort of return for it, you've got to buy it for less than its face value, haven't you? And for that reason, we call them discount instruments. So simplistically, just look at the lender. The lender lends 99,750, and then at the end of 3 months gets 100,000 back. So they make a return, they make a profit. The US Treasury simply takes the money and pays the nominal back. Now, if we wanted to work out what the lender's return for the 3-month period is, we would just do this simple calculation. Okay, on the top line, you've got the gain or the profit that the investor has made, and all we're doing is we're expressing it as a percentage of what they invested. Now, the trouble is, the answer to this equation is what we call the HPR, the holding period return. The holding period was 13 weeks. And the return on our investment for 13 weeks was 100,000 minus 99,750 divided by 99,750. But that's not enough. In financial markets, we always like to express things on an annual basis. So instead of chopping an annual rate down to a week, like we did with the deposit earlier, here we've got to take a 3-month rate and inflate it to an annual number. We've got to annualise it. And we do that by inverting the day count fraction that we saw before. Okay, so this is the convention by which we annualise the holding period return. Now, you may think you know compounding, discounting, that sort of thing. Believe me, you haven't even started. When we start looking at this, you have to do it in different ways according to money markets or capital markets. Okay, you might as well get used to it now. We use these fractions for money market periods. Now, sometimes you will see not the yield. Okay, the yield is your return. Okay, expressed as a percentage. Sorry, I'll say again. The yield is your return expressed as an annual percentage of what you invested. Sometimes, with T-bills, you will see a discount rate quoted. Okay, now this is useless. It's a waste of everyone's time. But that's not to say you're not going to see it. Decide reading definitely mentions it. This is the gain that you make expressed as a percentage of the nominal value rather than what you invested. It's a meaningless return. Nobody experiences it. You know, when I invest in the T-bill, I experience a return of 0.9915% per annum. Now, large companies like the idea of borrowing money the way the government does using treasury bills. So corporations, large corporations, have their own version of the treasury bill called commercial paper, or CP. Now, the biggest element of the CP issuance market are banks. Okay, so most commercial paper that you see will have been issued by Morgan Stanley, Nomura, Barclays. But you also get large companies issuing commercial paper as well. And what happens is exactly what we did before. The lender, like a money market fund, don't worry too much about that, but they basically lend cash and they receive, not a T-bill, but a piece of commercial paper. There is a question, though, as to how long the maturity might be. In the US, there is a regulation that stipulates if you issue something like a treasury bill or a commercial paper, and its maturity, its original maturity, is longer than 270 days, which is roughly 9 months. Okay, so if you issue a piece of paper and its maturity is longer than 270 days, you have to register it with the SEC in the US. And this is a long, drawn-out, bureaucratic process. Having lived in New York for a couple of years, bureaucracy is a big pastime, you know, like form filling. So most US entities, if they're going to issue commercial paper in the US, maturity won't go beyond 270 days. We call this USCP. However, if you are a large entity, if you are Disney, and you want to, you're Disney Paris, and you want to issue some CP because you know you're not getting enough of the rides and you've got to pay whatever, yeah, you are issuing your commercial paper outside the US. So you are not subject to US rules and regulations. And we call this EuroCP. But you'll understand why now. And so EuroCP can have a maturity of up to 12 months. It is not affected by the domestic 270-day registration nonsense that USCP is. So, in money markets, so let's just go back here for a second. In money markets, you have people borrowing and lending amounts of cash. Okay, you have an interbank wholesale market. And from the wholesale market, we take LIBOR every day. We take a sample And that's our LIBOR rate for those different periods, for those different currencies. But you've also got the government coming to the money market to borrow money. But they don't borrow from the banks. They borrow directly from people with money, investors. And they do so by giving them a treasury bill. A treasury bill is a very simple, single-cell financial instrument. You have to buy it at a discount to earn any sort of return from it because it does not pay anything more than its face value at the end of its life. In other words, it doesn't pay what we call a coupon. Okay, it's important that you understand that coupon is an extra payment that comes out of the instrument on top of the maturity value. Now, the great thing about a US Treasury bill is that if I lend my money to the US government for 13 weeks, I can, after a month, get out of it. I couldn't do that with a cash money market deposit, but I can do it with a Treasury bill because I can sell the Treasury bill to you. It is a transferable loan to the US government. So there is a market in second-hand T-bills. And it's a very busy, very liquid, very big market. Because this is virtually, by the time you get up to sort of pension fund, sovereign wealth type scale of money, you're not holding bank accounts, you are holding your cash, what you would think of as your cash reserves, you're holding them as US Treasury bills because they're nice and safe. And they're easy to get rid of or acquire more if you need to. They're a liquid trade. Somebody somewhere will always sell you some or buy some from you. And it's the same with commercial paper. Okay, you could lend money to Disney for 3 months, and a month through you could sell your CP to somebody else. They're transferable. The only difference is that with CP, here's the same picture that we had with the Treasury bill, just with CP. It's a discount instrument. We calculate the yield and the discount in the same way. But the problem is, with CP, are you going to get your money back? And what the market does is it relies on 3 organisations called credit rating agencies. Now, if you're Disney and you want to borrow money by issuing commercial paper, you need to have regulatory approval because you're almost acting like a bank, even though you're not. Yeah. And you also need to have a credit rating so that investors know, so investors have an objective opinion outside Disney as to Disney's capability of repaying the commercial paper when it comes due. Now, Disney know that nobody's going to buy their commercial paper unless it's rated. So Disney pay one or more of these ratings agencies to analyse the commercial paper and Disney's ability to repay it and come up with a report score or a credit rating. And you can see we've got superior, satisfactory, adequate, speculative, and defaulted. Now, this red line here is an important line. Above this line is called investment grade. Below this line is called high yield. And we're going to meet these 2 terms later. Regulators will say that in the UK, a pension fund is going to be limited as to how much high-yield commercial paper it can hold. Okay, so it's a way of regulating the amount of risk that investors take. So this goes back to, we're almost going full circle here. Disney knows that because big investors have to know the credit rating of something before they can hold it, nobody's going to buy the commercial paper unless it's rated so Disney pay Standard & Poor's to rate it for them. Now, a third money market instrument is CDs, or certificates of deposit. Okay, so we've got T-bills, commercial paper, and now we're going to look at CDs. Now, a CD, really, to all intents and purposes, is simply a money market deposit by an investor with a bank, Z Bank. But what happens is that the investor asks that Z Bank issues a security, a piece of paper, to represent the deposit that they've made. Now, Z Bank might say, well, okay, if this was a regular money market deposit, we would pay you 1.125% per annum. But as we've got to go through the hassle of issuing this CD, this certificate of deposit, this piece of paper, we're going to pay you slightly less. Now, the investor is happy to take a slightly lower interest rate on the deposit because this is flexible from their point of view. If it was a regular 6-month money market deposit, that would be it. They've waved goodbye to their money for 6 months and they're never going to see it again. Well, they're going to see it again in 6 months' time. Not bad, yeah? Whereas with this, what they can do is they can sell it. So 3 months later, the investor might sell the CD to another bank, K-Bank. And can you see what they're doing? Is they are inviting K-Bank to buy the CD. It's got 3 months remaining, hasn't it? And the investor gets their cash, and they, in effect, they'll get 3 months' worth of the 1% interest. You okay with that? So in 6 months' time, it would pay the 1%. But when we do our transaction with K-Bank, we say, look, you can have the CD, but you've got to pay us more than 10 million for it, because we want our share of the 1% interest you will get when you return the CD back to Z Bank at maturity. Okay, so you can see, can't you, these are much more flexible than a standard, regular money market cash deposit. They're closely related. Can you also see that the certificate of deposit does pay a coupon, doesn't it? Okay, so the coupon is the 1% on top of the face value that it will pay at the end of its life. It is not a discount instrument, okay, because the investor has to put 10 million with the bank, and then it pays extra at the end. Whereas with CP and a T-bill, we discount the face value in order to engineer some sort of return for ourselves at the end of its life. Can you see the difference? So where's the credit risk here? Is the credit risk with Z Bank, K Bank, or the investor? When K-Bank, well, it's not the K-Bank, so when K-Bank comes to buy the CD, who are they worried about? Z-Bank. Z-Bank, yeah, Z-Bank, wherever you learned your English, yeah. So Z-Bank is where the credit, so the certificate of deposit carries Z-Bank. So it's bank level risk, isn't it? Mm-hmm. Now be thankful that this isn't 35 years ago, and we'd have to do something called bills of exchange, acceptance credits that used to be a big part of money markets. Yeah? Nightmare. But they don't exist anymore virtually, nobody uses them. So they're gone. Okay. Right, that'll do us for today. We'll start tomorrow with repos. Okay? And we'll carry on looking at all sorts of different instruments and markets. So before you go, do you have any questions? No questions? No? You all right? Christos, you don't want to? Yeah? I'll see you tomorrow. Good night. Remember there's sign-on sheets down here if you need it.